Analyzing your situation. In this video, we're going to put together your financial statement. Now, this is perhaps the most tedious part of the planning process, putting down actual numbers that make up your financial profile. In our download section, you will find a financial planning template that will help you through this step. At this point, it's absolutely important to be honest with yourself. It doesn't matter what your financial statement looks like. What is important is that you get started. So if your numbers are not up to par, it's all right. It's important to acknowledge this and move on towards better and bigger things. So start with your income and work downwards, filling out all the applicable areas in the financial template. Now, what we found is people usually have no problem filling out the income statement. It's the balance sheet, the assets and liabilities that they struggle with. If that's you, don't worry, I'll guide you through each and every aspect of it. Now, as we saw earlier, the balance sheet has two components, assets and liabilities. We define assets as anything that puts money into your pocket and liabilities as anything that takes away from you. So typically, assets are investments. Now, you want to look at all the investments that you've made and understand which are the ones that are actually giving you money. So these are investments that are yielding positive returns. So if you have a business that you've invested in, put that down there. If you have mutual funds or stocks, those go here too. Each of these items will have an income component as well. So understand how much money each of these assets are making for you, if they are, and put it down in your income statement as well, in the income column of your statement, and put it under passive income. So the monthly income generated from these assets will appear in your income column, and any related costs will appear in your cost column. So for example, if you have a rental property, then the rental income from that will go into your income column, and any associated costs like whether you're paying an EMI on it, if there are any maintenance costs, if there are any taxes, those go under your cost component. And obviously the net effect of these two will get reflected in your financial statement. Liabilities, as we know, are things that take money out of your pocket. So list down all the liabilities that you have and correspondingly put down the expenses that you incur towards these liabilities every month. So for example, if you own a car, the EMI for the value of the car will appear in your liabilities column, and any cost associated with it, including especially the EMI component against the loan, will appear in your cost column. Now, at this point, I also suggest that you go through the case studies that we have in the fourth video. These videos or these case studies will help you understand the situation from a more third-party point of view as well. They will also help you in understand how each type of these costs, these entries are treated. So you will have a fair idea of what exactly to do with your situation. Now, before you continue, take the time out to put together your financial statement and understand all the components. Then we can go forward and understand how to analyze each of these components, how to analyze your financial statement. Once you've done that, the next section will help you understand your financial statement and really know what is working for you, what your financial system is, and how it is working for you. So pause right now if you want to prepare your financial statement and come back to understand how to analyze the financial statements. Now that you've prepared your financial statements, you've taken that first step towards, really understanding your situation. And hopefully you've also understood how some other people have worked out their financial statements. You're ready to get started in analyzing your financial statement. This will indicate where you are right now and help you set new goals to get to where you want to get to. Now in this section, you will see some standard ratios that are used to analyze your financial statement. Not all will be applicable to your situation, but understanding these ratios will help you move towards your goal of financial freedom. Firstly, how much do you actually keep? You take your total monthly income, you remove from that, you subtract your total monthly cost, and what you're left with is your saving, or how much you actually keep. Understand that as a percentage, and the goal here is to increase the percentage of your income that you keep. Start with 1% if you have to, and then increase it from there. Does your money work for you? To understand this, take your total monthly income and your total passive income. Divide passive income by your total income to get the percentage of income that is coming by way of your passive income. Now again, the goal here is to increase the percentage of your income that is coming from passive sources. And of course, if you have no passive or portfolio income, start by investing in some assets that generate passive portfolio income. What is your income after tax? For this, you take your total income and the total amount that you spend on taxes, subtract the taxes from your total income to get the net income that you have after taxes. Now, the goal here is to decrease the amount you pay in tax. Now, obviously, I cannot advise you to not pay your taxes, but consult your tax advisor to make sure that you're taking care of all tax deductions, all tax breaks that you will qualify for. If you have a business, for example, make sure that all the costs related to your business are being deducted from your overall taxable income. How much of your income goes towards housing? Now, this is an important aspect. It helps you calibrate where you are in terms of your spending habits. So you take your mortgage payment, rent payment if you're making rent payment, insurance if you have insurance on your housing or property. You include your real estate tax, utilities, maintenance, all these costs, and deduct it and divide it by the total income that you have. With this, you will understand how much of your income you're actually spending on housing. The goal here is to make sure that your housing cost is less than 33% of your net income. How much are you spending on indulgences? Now, indulgences are not a bad thing. They are the rewards for a job well done. Unfortunately, most of us look at acquiring indulgences first and never really come around building assets. The following figures will help you understand your indulgence habits. Note here that the total assets carry the tag banker's version. You'll recall there's a fundamental difference in the way we understand assets or how we qualify assets. We use assets as anything that put money into our pockets. But the bank lets you identify assets that have value, right? So the banker's version is anything of value that can be converted to cash. But that's not really, in the pursuit of financial freedom, that's not really what matters. What matters is which asset is actually giving us money at the end of the day. So understand those differences and qualify those assets accordingly. For example, your personal residence is not an asset according to our definition because it doesn't put money into your pocket. But the banker will let you qualify that as an asset because it can be converted to cash. It has value and it can be converted into cash. I know it's not easy to get around to really to admitting that your house is not an asset. Most of us are very proud of our houses and we feel that it's an asset. But as you pursue financial freedom, you have to understand that assets have to generate income. If they're not, then they are unfortunately indulgences. So to understand this, understand how much you have as indulgence assets and the total asset amount. Divide A by B to get the percentage of your assets that are actually indulgences. And vice versa, you'll understand how much of your assets are actually true assets. And again, the goal here is to keep your indulgences below 33% of your total assets. And of course, the lower the percentage, lower that percentage is, the faster your assets will grow. What is your return on assets? One way to increase your passive income is to reallocate your assets. So if something is not giving you enough returns by way of return on asset, then you may want to liquidate that and reinvest that in assets that are giving you higher yield, higher returns. So this ratio will show you how well you're doing. And if the returns are low or not as much as you expect, or you feel you can do better, go ahead and look at liquidating some of those assets and reinvesting that in other higher yield assets. So you'll take your total assets and the total passive and portfolio income, divide passive and portfolio income by the total assets to get the yield or cash on cash return on your assets. Again, the goal of course here is to increase your cash to asset returns. How wealthy are you? Now, when you're pursuing financial freedom, you have to understand that wealth, or the understanding or the definition of wealth, is not what we've been aware of. You see, wealth was qualified or quantified as the money that you have. But when you're looking at financial freedom, we look at wealth in terms of time. How much time can your wealth or your money sustain you? So for a poor person, for example, he's 0 days wealthy because if he stops earning, he is not going to be able to maintain his lifestyle even for a day. A middle class person may have some savings set aside and may be able to sell some of his assets that they have. So he may be wealthy by a number of days, let's say 90 days, 180 days, a year. The rich, on the other hand, have assets that are feeding them. They're not really relying on earned income, and therefore they are infinitely wealthy. So when we are understanding how wealthy we are, we need to understand in terms of days how long we can sustain ourselves if we stop working. Once this reaches infinite, that's when we realize that we've reached financial freedom. So go ahead and look at your financial freedom, financial statements to understand how wealthy you are. You take your total assets and your total expenses, and therefore your wealth is your assets divided by your expenses. And of course, include your total passive income. Once your total passive income becomes more than your expenses, you've reached your goal. So of course, the goal here is to purchase assets, true assets that generate income for you, and keep doing that while controlling your costs. And finally, what is your cash flow pattern? The numbers that you've come up with tell you a story. Which of these stories best describe you? If you have the cash flow pattern of the poor, you're using earned income to pay for expenses. You have no assets, no liabilities. You may own a lot of things and owe nothing on them. But in addition to having no debt, you also have no assets, then you have the cash flow pattern of the poor. If you have the cash flow pattern of the middle class, you're paying most of your expenses by way of earned income. which goes to pay for your expenses and build more liabilities, creating more expenses. If this is your pattern, you are rewarding yourself with indulgences that are being funded by your earned income. This is the most difficult pattern to change. Your cash flow is building more and more debt. The cash flow pattern of the rich builds assets that create passive income, which in turn pays expenses. So the term rich here refers only to the cash flow pattern. So what counts here is not if someone's making 5,000 per month or 5 lakhs per month. What counts here is where that money is getting generated. If that money is coming through earned income, then it's not a cash flow pattern of the rich. The cash flow pattern of the rich creates the income from passive income, from assets itself. And so what counts here is whether that person's expenses are being paid from earned income or passive income, with additional cash flow going towards acquiring newer assets. That is the cash flow pattern of the rich. It is not the amount that you make, it is what you do with it that counts. So what's next for you? By this point, you would have a fair idea of where you are, what your financial situation is, what is your cash flow pattern, what are your assets, and really where are you headed. The next step will need you to understand what you want from your life. If you look at your cash flow pattern, if you look at your financial situation and you're happy with it, then that's fine. But if you don't like what you're seeing, then now is the time to reflect internally and see where you want to get to. What are your aspirations and goals? Sit down with your spouse or partner or someone that you trust and discuss these goals with them. This is the time to take control of your finances and your life. Our next video will take you through the planning process and put you on the path to financial success. I'll see you there.